I got sick of on my sales calls when I'm trying to sell commercial to people.
Can you talk a little bit about that and what you recommend for people with sort of different investment strategies, like starting out, or if they've got a portfolio of one or two?
This is literally and figuratively the $1 million question. Like, you actually get the same capital growth and you get 3 times the rent.
And industrial, is there certain ones that you sort of avoid, or is it just sort of case by case?
Do you know what the vacancy rate for industrial properties is in Brookvale? 0%.
Rental income versus the expenses. If that then services the loan, there's no other financials needed, no other income needed. They'll approve it on that. It's literally as simple as that.
Once you've picked your area as well, you know the suburb stats.
A lot of the information's publicly accessible online if people know where to search for it. But if you're using tools like Archistar, the information's there and click the button.
The tenant pays all the outgoings and it's a net yield and all that type of stuff. So I was like, let's just write a little 10-page ebook.
So many properties leasing at any one time, and there's high turnover as well with 6 or 12 month periods or tenancies in place. With commercial,
if you are going through an owner-occ, it is a full doc process. So if you are buying it to live in it or to occupy it under your business, it is a full doc. So it's usually 2 years financials, tax returns. They want to be able to see that you can service that.
There's going to be a very limited number of properties for lease at any one time, but obviously then the lease periods are much longer as well.
Welcome back to Talk Property to Me. My name is Brad East.
I'm Aaron Downie, and today we've got Steve. Steve, you can introduce yourself.
I'm Steve. No, I'm Steve Palise at Palise Property.
Perfect. So you've sort of been in the buyer's agency space for a while now. What do you specialise in at the moment?
I try to do everything. I want to be known as the guy that gives unbiased advice. I'm sort of known as a commercial kind of guy because I wrote the first commercial book in stores. But I've purchased 1,200 residential properties for clients. So I got based there. And now we're also kind of doing developments for clients as well. But I want to be known as the guy who people come to and I don't kind of push them into my niche. I just say, look, I think this one's right for you. But about 80% of my work is buying commercial investment properties.
Perfect. So that's why we've got you on today. Is obviously we really mostly talk about residential property on this podcast. So it's really good to have you on the show, mate, to talk a little bit more about commercial property and how that can really help people's overall portfolios. Had a little bit of a stalk on yourself as well. I believe you're an author of a book as well. Do you want to have a plug on that while you're on here?
Excuse me, 3 books. 3 books.
A few books.
I actually had a real cool humble moment. I was flying last week for work in Melbourne. I went to the airport and all 3 of my books were on the end bay. I was like, that's pretty cool.
That's awesome.
But the background behind that is I didn't plan to be an author. I got sick of on my sales calls when I'm trying to sell commercial to people, having the same conversation because people don't understand. We'll talk about in this podcast, like the tenant pays all the outgoings and it's a net yield and all that type of stuff. So I was like, let's just write a little 10-page ebook and I'll send it to them before the call so I don't have to spend half hour every time explaining the same thing. And then I realized I couldn't get in 20 pages. It was like 100 pages. I went, there's a book here. And then just randomly sent it to a book publisher. And she came back straight away and was like, you're the first business person I've met who's written a book word for word. Normally you get a ghostwriter and you just kind of got pointed out. Yeah. But I didn't know. I was just naive thinking authors wrote books. And then they 4 weeks later, a bit of editing and it's in stores.
That's probably what led to the other 2 books.
So funny, I sort of alluded to it. What happened was every time I had a client, they'd kind of go, oh, you're just going to convince me to buy commercial, Steve. You love commercial. And I was like, well, no, I own 9 residential properties and I've bought 1,200 of them. Like there's a thing there. So I begrudgingly wrote the residential book. Admittedly, got a ghostwriter and dot pointed it all out because it's a little bit simpler. Yeah. Again, just to give unbiased advice. And then my general manager, who's a developer, he's like, let's close out the series, Steve. So I co-authored the development book with him, which came out a couple of weeks ago. But I'm done. No more books.
No more books.
It's a
the education's
process.
There.
Just with a baby at night, I'm trying to spend a few hours every night writing a book. It killed me. But good, nice to close out the trilogy, I think.
Yeah. I think what you mentioned there with unbiased advice is super important, especially knowing the industry myself. You mentioned that you do both resi and commercial. Can you talk a little bit about that and what you recommend for people with sort of different investment strategies, like starting out, or if they've got a portfolio of one or two, and then they want to try and do a little cash flow play. They don't know much about commercial. They're considering resi. What should they do?
All right, so this is literally and figuratively the $1 million question, and I've been talking for a while, but I'll also kind of summarize.
Yeah.
Generally, it comes down to three things: what you're trying to achieve, over what time frame, versus what you've got to work with finance.
Yeah.
So what I mean by that is, if you're, let's go both ends of the spectrum. If you're starting out and you're a 20-year-old, there's no point buying commercial because the whole point of property is leverage.
Yeah.
You've got leverage up your sleeve. You've got servicing. Go leverage up if you've got the risk profile. Get 90, 95% loans. Refinance the other one. Get 100% loan. Build that base portfolio. And it's not a cash flow pay at that point. It's a build up as big a portfolio as you can.
Yeah.
Use bank of mum and dad if you need for parental guarantees, all that type of stuff.
Yeah.
Because it's accumulation phase at that point. The other end of the spectrum is, say you're 63 years old and you don't have a portfolio, but you got a big cash and you want to retire. Buying a negatively geared residential property is not really helping retirement. So we've got to focus on cash flow, which is where commercial comes in. So everyone in between those spectrums will kind of have a fit based on their servicing, what they're trying to achieve, what time frame. But if I'm honest, most of my investors are pushed into commercial because of their residential servicing.
Yeah.
And we'll talk about it a little bit later, but with commercial, effectively, as long as you got the deposit, you can keep buying on a thing called a Lease-Stock loan.
Mm-hmm.
So you basically got infinite lending, but coming up with a 30-35% deposit it's pretty tough. Like $1 million purchase, that's 350 grand.
Yeah.
So that's the kind of bottleneck. So most of my investors have a bit of a base portfolio, 2, 3, 4 properties, and then they buy a commercial just because they can't keep buying residential. And then there's offshoots as well. I've personally sold 7 of my residential properties and bought an entire shopping center that's like it's 3.1 mil and gives me 100 grand passive income. So now I'm like, oh, sweet, I'll sell the other 2, put a bit more business income into it, buy another 3 mil one, 200 grand passive income, and they'll actually pay off their debt within 7 years. And then I'll have about $500,000 passive income.
Yeah.
So all of a sudden with 6 mil portfolio, I've got $500,000 passive income. To do that with residential, you are literally talking 15, 30-year plans and 12 mil plus portfolios.
Yeah.
So it's
no, keep going. That's the thing. A lot of people get into resi. Obviously they just want to make money. That's mostly the strategy. And it's thinking about those long-term goals. And to get passive in resi, it's like you said, it's a super long-term strategy.
Yeah, commercial, like we can talk about this on that now, but like commercial is a better performer. Like you actually get the same capital growth and you get 3 times the rent. So on paper, you make way more. The hard thing is getting the deposit. Yeah. There's a couple lenders doing 80% loans, but most of the time you're talking 30-35% deposits, which most people just don't have.
Most of the 80%ers are owner-occ as well.
Yeah, exactly right. So it's,
which kills the appeal of it instantly.
Yeah, exactly right. But like I said, on paper, and that's we'll talk about that. Like one of the myths is people say, "Oh, commercial doesn't grow," and I'm like, "Well, where does that come from?" The way I kind of joke to them is I say, "Oh, do you think commercial's expensive?" And they go, "Yeah, commercial's really expensive." I'm like, "Well, how did it get expensive if it's not growing at the same rate as residential? Shouldn't it have less growth rate over 30 years?"
The same price that it was 30 years
exactly
ago.
Right. But there's a few reasons for the myth. So something like an office space won't grow the same as a house because one's got a land component, one doesn't, one's got scarcity, one doesn't. The same as if you go buy an off-the-plan apartment in Perth, that doesn't have the same growth as a house. So it's always case by case. The other aspect to it is generally the markets, they kind of grow in different cycles. The resi market will pump and then the commercial market will grow. So all the time the resi people are talking about their property portfolio growing, the commercial sitting there because there's a delay due to the leases. However, in the last 5 years, because of the e-commerce boom, that hasn't been true. Like most of the commercial industrial we've bought has grown 50% in the last 5 years. So you still get the same capital growth. The negative, I don't want to sugarcoat it, is if you don't know what you're doing, you can burn yourself massively.
Yeah.
We've all seen commercial properties vacant for years. You know, I've seen that personally in Newcastle.
And that's just mitigating risk with any investment.
Yeah. 100%.
But that's the thing. So this is a bit of one of my pet peeve, no offense, Brad, is people will see a retail shop sitting there vacant for 2 years and then tarnish the whole commercial. Yeah. I live on the northern beaches of Sydney. Do you know what the vacancy rate for industrial properties is in Brookvale? 0. 0%. So all of North Sydney, there is 0% vacancy rate. And then people go, oh, it's really high risk. But the way to look at it as well is you get 3 times the rental return. So theoretically, I can go buy a warehouse. It can sit vacant 2 out of 3 years, and I'm still in a better cash flow position. But the difference is you need a bigger buffer, because obviously if you buy an asset that sits there vacant for a long time, having a mortgage and paying that's a bit harder. Residential, okay, I'll be out 2-3 weeks, kind of worst case. I might have an air conditioner blow up, a roof leak, etc. The buffers are a bit small and the planning's a bit easier.
Is there certain property types that you're avoiding? You've mentioned office and you've mentioned retail and industrial. Is there certain ones that you sort of avoid, or is it just sort of case by case?
Case by case, but general rule of thumb is I really like industrial. It's easier for investors to get their head around, because they can look at, like, if you're buying in a body corporate warehouse complex, all the other ones in the same complex, what they sold for per square meter, what they rent for per square meter, when they went vacant, how long they were vacant for. Then you can do the adjoining warehouse complexes, and you can get a bit of a mathematical formula behind of, like, okay, if I've looked at the last 2 years and the longest period of vacancy was 5 months, cool. 6-month buffer, 12-month buffer should be right. That's a good tightly held area. But I like industrial as well, because you've got a land component and you can't make any more land. So if you're well encapsulated by residential and the local government area is increasing the population, why would you have lesser demand for, like, car mechanics, wholesalers, distributors, fabricators, storage? So for me, they're a good low risk long-term play. I don't like retail, but in the sense of CBD retail, where it's like oversupplied, high priced, low yields. I really like suburban retail. So, example I mentioned, I just bought a little shopping center. That's 8 shops, 3.1 mil, completely surrounded by residential by 1.5 kilometer radius. So I've got 5 square kilometers of houses that are using my services. And over the last 10 years, there's only been 2 vacancies in the strip, and the longest period of vacancy was 6 months. So you can still do it. And again, people need hairdressers, barbershops, cafes, like service.
From memory, there's some differences in the leases between retail and general as well, isn't there?
There's the Retail Leasing Act, which just means there's a few things you can't pass on to the tenant, such as like land tax and property management. But when you're working out your net yield anyway, you take that into account. Office space, generally, I've never bought, just because I don't like paying lots of money for airspace. But there's exceptions to the rule. Like, you also get a better yield. You can buy office space at 7.5%, 8.5% at the moment, whereas obviously industrial in, say, Brisbane is 5.5%. So you're getting like 30%, 40% more rent there. I really like the smaller office blocks in kind of lifestyle areas. So I use my example again, like Northern Beaches. We've bought a couple little office spaces in Balgowlah, which is like a suburb next to it, but they're little buildings with only like 4 tenancies. And they actually duplicate. The one we bought a couple of weeks ago was actually a ballet studio. So it's the second story of the thing. So it's sort of a retail without being kind of typical office space. But like you said, case by case.
Like a high-rise office space sort of stuff.
Yeah. But again, I don't buy high-rise like apartments either for residential. But just generally, good location, tight vacancy, versatile premises, good yield, long lease. Like, that's generally what you're looking for.
I mean, very similar in the resi case, and with that scarcity component, Steve, are you mostly buying in metro areas?
90% capital cities.
Okay.
And in a well encapsulated area. So what I mean by that is surrounded by residential. So I'm not going to buy greenfield on the fringes of Perth, because that's hard to predict vacancy rates. Like, if they build 50 warehouses in the next 5 years, I can't gauge what the vacancy rate is. But if I see like surrounded by residential and they're changing the zoning from low mid density to medium density and they're not building any more warehouses, I'm not going to say capital growth, but I can at least predict more demand for that property in the next 10 years.
Yeah.
But pretty much major capital cities, Brisbane, Sydney, Canberra, Adelaide, Perth are the kind of big ones. If I'm going to go regional, there needs to be a bit of an X factor about it. So again, I'm not talking like tiny little 20,000 person towns. I'm talking like the big ones, the big 100, 200,000.
Castle Wollongong.
Yep, exactly right. Normally there's got to be an X factor about it. Either like a really long lease, or like Newcastle, we bought a pet barn. So like stuff like that. That's a fresh 7-year lease. If you're going more regional, so say you're going to like a Townsville, I want to get like a multi-tenancy. So like for there, if you go spend 2.5 mil, you'll get a retail strip with 15 tenants.
Yeah.
And I can probably argue, okay, that's fairly low risk compared to buying one Sydney warehouse. So you can kind of mitigate that. So regional X factor, but I've got 5 acquisition staff just covering Australia. And that's the hard thing with commercial. You can't just pick a suburb and like, let's wait for that one for a property to pop up. Otherwise, you'll be waiting 6-12 months.
With that multi-tenancy, say that example that you said where you've got 15 different tenancies in place, is it then hard to manage, or are you just using one property manager to manage the entire complex?
Yeah, so that's probably the negative rhythm, but you pay a property manager.
Yeah.
So I'll give you some as an example. So I pay around 20 grand a year for the management.
Okay.
But again, I'll take that into account. So I'm still getting a 6% plus yield.
Yeah, for sure.
But you're reducing the risk by having, like, if I lose a tenant, I've still got 7/8 of the rent coming in.
Yeah.
Whereas if you buy a single asset and it goes vacant, you got to handle. So your buffers are a bit different there.
Mm-hmm.
But everything's got a pro and a con. The negative of owning like a whole retail strip like me is there's more maintenance, like because I own a big car park and a retaining wall and the big roof, and there's all that type of stuff leading to it. Something like an industrial property, it's 3 concrete tilt-up panels and a roller door, and it's really versatile.
Yeah.
So that's the positive of that one. But you're only getting 1 or 2 tenants, whatever it may be.
Yeah.
But that's the fun part of commercial. Like, we can even talk about that. Value add opportunities in commercial are really cool and interesting as well.
Well, that's the thing. There's always a lot of people just see value add opportunities in resi because they just know houses. But commercial, there would be massive value adds for all different types of properties. So it's probably worth speaking a bit about that as well.
Well, you're saying this as someone who's like a smart investor. Most people say the opposite and go, "Oh, you can't do anything with like a warehouse."
Yeah.
So basically, you can do anything you can do in resi in commercial. You can still buy freestanding site, subdivide. You can still renovate if you've got like a retail shop and things like that. But normally the price to entry for a value add is a bit more. You can go buy a 400, 500 grand house in a regional town, spend 30 grand on it and renovate it.
Yeah.
But you can still do all that in commercial, but then you've got other stuff like a commercial's valued based on the net rent that you get. Mm-hmm. So simple one, buy a warehouse, build a mezzanine floor on it, increase the square lettable area. If you get an extra 20% rent, 20% more value. There's a funny one in my book where it's across from my physio in Concord in Sydney. It's a fish and chip shop with an ATM machine, a residential property on top, and telecommunications on top of the building. So they've got like multiple tenants. So you can do stuff like that. We bought one a few months ago. We put an advertising board because it was on a major highway, and that gives them 100 grand a year. I mentioned telecommunications. Simple one, dividing the tenancies up into smaller ones. So if you buy let's say an industrial property with 3 or 4 roller doors, you can build firewalls down the middle, separate the tenancies, and smaller sites get a higher square meter rate than a larger site. So again, you're increasing the rent by 20%. You're getting that way, you're diversifying that. Solar panels, off-peak renting. I've got a cafe that they rent off-peak to musicians and stuff like that to do like thing. So you can get so there's all that type of stuff you can do. So it's a bit more interesting. But again, you got to know what you're doing.
I mean, you have to be more of an active investor and know this stuff, unless you're engaging in services like yourself and go to the extent of doing that. But a lot of people, especially in resi, they just want to buy and forget about it almost.
Yeah, but I'd say 70% of my clients are in commercial like that as well.
Okay.
Funnily enough, I'm not a value add investor.
Yeah.
All my properties I buy are very boring, tick the box ones because I'm busy enough in my life with work, my relationship. I travel 4 months of the year. Like this weekend, I'm going to Vietnam for 3 weeks. So I travel and I've got a daughter, as I mentioned as well. So my investments are something I just don't want to think about.
Yeah.
Which is funny. Most of my periphery, like referral partners, like my accountant and all that, told me I'm an idiot. They're like, Steve, you got 15 staff looking like around Australia for you. Why are you not getting the golden opportunities? And I'm like, when's enough? Like at some point you got to just like relax a little bit.
There's plenty of relaxing for retirement, in my opinion.
And I say that a bit facetiously as well, but I was the opposite when I started out. Like to get to 9 properties as like a young engineer, like I was obviously doing all the renos myself, all the value adds. I'll start till 2 a.m. every night researching property. Like it's not like I'm doing that now that I'm 12 years into my investing and I'm just tired.
Yeah, for sure.
Brad, you mentioned it earlier. One of my favorite things about the commercial property is you mentioned it earlier, is the Lease-Stock. So to explain that to the listeners is basically what lenders do is they look at that property in isolation. So they'll look at the rental income versus the expenses. If that then services the loan, there's no other financials needed, no other income needed. They'll approve it on that. It's literally as simple as that. We've done plenty of them over the years, and there's a few lenders that are still doing them really well. But as you said, if you're starting to get maxed out in certain situations, in your personal names or even under your business, it's a really good way to then sort of borrow more, and there's no limit to how many you can do under that situation as well.
Yeah, it's also a nice diversification as well, especially if you're holding like a negatively geared portfolio and you're trying to offset some of that as well. But like I keep saying, like you need to know what you're doing, and this is why obviously I'm trying to sell my services as well. But like there is so much to do with like due diligence. Like we have to do an 80-page due diligence report, which takes about 20 hours. Residential, no offense, Aaron, within a few hours you can cross check like flood zones, get the stats. So like once you've picked your area as well, you know the suburb stats and all that type of stuff.
And the thing is, a lot of the information is publicly accessible online if people know where to search for it. But if you're using tools like Archistar, the information's there at a click of a button.
Yeah. Commercial, like I'll give you a brief overview. So like you got to do things like lease review, contract review, tenant interviews, like you actually talk to the tenant, vacancy study, occupancy study, you check rental ledgers, P&L statements, like service contract. Like you get about 50 to 100 documents you've got to cross check. And people don't do that with resi. They look at the pretty picture. They go, oh yeah, that looks all right. It's not a flood zone. It's not riddled with termites. Happy days. Commercial, there's so much going on. Even like a vacancy rate. Like a novice resi investor can just go on SQM research and type in their postcode and go, oh, cool, yep, 4-bedroom house, vacancy rate's 0.6%.
Yeah.
That doesn't exist for commercial because there's no definition for what a commercial is. You literally have to go on CoreLogic, click through every comparable you found, look at the leasing campaigns, how long the leasing campaigns went for. Then you also need to call about 3 or 4 property managers in the area and find out what they had on the books the last 2 years, what went vacant, and just collate it. Like that's just a 6-hour exercise by itself.
Well, that's the thing. Like with resi, you've got so many properties leasing at any one time, and there's high turnover as well with 6 or 12 month periods or tenancies in place. With commercial, there's going to be a very limited number of properties for lease at any one time, but obviously then the lease periods are much longer as well. So the data just wouldn't be there to, provide it for vacancies.
It's just, you got to do calculations as well. Like even just value in a commercial, like we've got an in-house valuer, like a fully qualified valuer in our team to get the thing. Because like residential, you kind of look at like, oh, let's look at 4 3-bedroom houses. Oh yeah, look, this one's a bit nicer, a bit newer, slightly bigger land. Like and you kind of just do a bit of a thumb suck.
Yeah.
Commercial, like you don't know what's like inside even. Like you're looking at a warehouse, like freestanding is completely different to a body corporate. Some of the body corporate ones have a really nice office fit out. Others have a mezzanine floor in it. Some of them have turning circles for trucks. Some have 5-meter high roller doors. Other ones got a crane, overhead crane. Like there's just all these nuances. So it's not just simple as like, oh, look at that one. I'll look at that one. I'll look at that. Like everyone, you got to look into the nitty gritty as well.
Yeah.
Which is a good and bad part. I run a business doing all that work for people. And I reap the benefits because not many people are willing to do it.
And for people, I mean, like you said, there's not many commercial buyers agents out there. If someone is, I mean, there's a lot of people who do have good experience in the resi space. They know property. They're interested in property. If somebody does want to try and learn about commercial or buy a commercial asset without a buyer's agent, how would they go and do it?
Funnily enough, I actually give all my information away for free. So I don't have any secrets.
Read Steve's book first.
Literally go on my website, policeproperty.com. You can get all 3 of my books for free.
Yeah.
Like you pay your $10 postage just so I don't get a billion people kind of taken away. I've also got a 10-hour commercial course. So if you go to the commercialpropertyinstitute.com, I've got a 10-hour course going the ins and outs of how I check everything, where it all comes from. You can definitely do it yourself. What happens to most people is they do the course and then go, I can't be bothered doing this every night for 5 hours to find even find a property, let alone do the due diligence.
Yeah.
And then
my biggest thing's time. I don't have time to do shit. I've got 3 kids. You guys, Aaron's got 1 on the way. You've got 1. You said, times that by 3. That's how much time I've got.
Yeah, because I don't do any like hard sales. Like I never do cold calls. I never do cold emails. Most people come to me. They go, oh, Steve, I listened to your podcast. I read your book. I did your course. They already know what I'm about, so I don't have to sell anything.
Yeah.
Like you said, I sell that I'm going to save you time. More importantly, I kind of try to sell that I'm a bit of an insurance policy just to make sure you don't make a mistake. And that's to be honest my real benefit.
With the entry level, what sort of entry level pricing are you looking at? Sort of, let's say someone wanted to buy a commercial property, one of the listeners, they don't have a huge deposit. What sort of minimum purchase prices would you be looking at for your customers?
We got one last week for 300K, a little warehouse in Brisbane. General rule of thumb, 500K plus, you start moving into the better stuff. There's a negative with the little ones. Funnily enough, I actually think you're getting the most capital growth because they're really in demand because every armchair investor wants one. So I think they're going to go from like 300 to 500, and that's percentage-wise pretty good. But the negative with the little small like warehouses, for instance, is the tenants aren't signing long leases. They're average Joe's electrical services or whatever it is. They're going to go one or two ways. They're going to grow and outgrow the space and move into a bigger warehouse, or they're going to close up shop. So you're getting a 12-month lease where they're probably going to leave within a few years, and then you have to find another tenant. Which vacancy periods in the stuff we buy is generally like a month. So it's not a showstopper. My brother, who heads up our due diligence team, he buys lots of 500K ones because he's diversifying location and doing it that way. But if you move up to say like the million, then you start looking at 3, 4, 5 year leases. They're there on average 5 to 10 years, and the vacancy periods are like 3 months. So I would say 500K is a good starting point. Normally, if you're going less than that, there's probably better servicing in resi anyway. And there's also other ways to get good cash flow. Like you can talk to like Aaron and do house and granny flat strategies and all that type of stuff.
I don't do granny flats. So
good. Talk to Steve Palise then. Come to Palise property. Come to the dark side.
It's a good segue because, like we started on with people buying resi, or obviously you're investing in property to just cash flow or capital growth. When should people get started with commercial? Should it be an upfront? Obviously, there's bigger entry costs, or should they have a few resi investments to leverage first?
I'll answer the question with when not to buy commercial.
Okay.
So when not to buy commercial is if you're too early on in your journey and you've still got lots of servicing. So i.e. you can leverage your money further. The other one is if it doesn't suit your risk profile. So you can't handle a 6-month vacancy. You're just kind of too tight week to week. There's too much financial stress. A low risk resi might be a better option.
Yeah.
And then the other one is when you're not educated enough. So i.e. you just don't understand it. Like don't touch anything you don't understand. And that's why I give all the education away for free.
Yeah.
And then move into it. But most people are doing it either for a cash flow reason. Mm-hmm. Like we get a lot of mum and dad clients say, we just want a nice little 25, 30 grand passive income. So my partner can work 2 days a week instead of 4, et cetera, et cetera. A lot of it's for retirement planning where people have a 10-year plan of they want 100, 200K passive income. Someone like me who doesn't want to work forever and has got like a bit of a 7-year horizon, I've done the accumulation to a pay down to then build an instant big passive income. So it's like I mentioned before, what you're trying to achieve, what time frame, and you use your finances to kind of allow that.
And I think it's really important what you said there. And Brad and I were discussing 2 things recently with granny flats, but also people buying in corporate entities to try and expand their portfolio further for servicing. It should, in that situation, instead of doing a granny flat or instead of trying to rapidly expand your portfolio with these corporate entities and then shortfall once you reach a certain point, is that when they should transition maybe to commercial if they understand it and have a better risk profile?
This is also why you need an experienced commercial mortgage broker, because like a lot of the resi ones, and I know, Brad, you do commercial, so it's not a reference to you. The resi ones will just leverage you up and they don't care about commercial because they don't understand it, nor can they get it. Whereas at least if you're talking with your broker about your goals and your plans and your timeframes, they're going to let you know where the glass ceiling is. So you can at least kind of plan for it moving forward. The biggest thing I actually find is people don't actually assess what their goals are. Like most of my clients just come to me and they go, I want a 200K passive income. And I'm like, well, what do you want that for? And they're like, so I can travel the world. And I'm like, well, I just spent 2.5 years in Europe working my business from over there. And I spent around 130 grand. So I'm like, and that wasn't me slumming it. That was traveling around to 20 countries, staying in hotels. Yeah. I'm just kind of like, why do you need that? Like, why we move the horizon now to 25 years instead of 10 years when 75K might be enough? Yeah. But as you guys know, like people get caught up on the Instagram hype and all that type of stuff of like, look at this Ferrari, jet boat, blah, blah, blah. Only do that if you get enjoyment about it. I've got clients that love Rolex watches and Lambos, and we play the game to get a big cash flow. I like rock climbing, hiking, and traveling, so I don't need that much, nor do I need or want a 20 mil portfolio. That seems stressful to me.
Yeah.
We talk about that on almost every episode. Is the thought of having 80 properties or all this shit people say is no chance.
It's the buyer's agents that just like they pull a number like, oh, I've got 100 property I want, and you're kind of like, well, why not just get 10 really good assets that it's lower risk?
Correct.
I'm saying this in a positive way as well. It's an ego driven thing, but that can also bring happiness. Like setting goals. Like I was setting a goal in my business to make your first 100 grand. And like, that's just purely a vain metric of I want to make 100 grand. Then the next one becomes 200 grand. And that's just to feel good about myself. But you just got to internalize and realize I'm doing that so I can just feel like I'm progressing. It's not an actual need for my life. I'm always going to have a roof over my head, food. I'm going to be okay.
Yeah, for sure. But I think what's important to mention is particular markets, and I say this reluctantly because I know it all comes back to clients' goals. With residential, everyone asks me, "Oh, where should I be buying now?" And it's like, well, there's so many markets to buy in, but I'm sure it's very similar in the commercial spaces. But is there any areas that you're sort of looking at for clients at the moment for different assets or different price points?
It's funny. I actually spoke to a couple of the guys who own the. This was yesterday. The data software, like Suburbs Finder and HTag and all that.
Yeah.
And they were actually pointing out that it's like when people say, "Oh, where should I be buying?" And they both said the same thing. Like, well, it depends on what your brief is. Like, are you looking for long-term stable capital growth where we'll look at the 20-year trends and forecast that? Are we looking for a short-term uptick to refinance?
Yeah.
Then what's your budget? That's going to change the area as well. What's your risk profile? So, and this is why there's no strategy for property investing. It's dependent on the person.
Yeah.
But to answer your question, I look everywhere, assuming it's a good asset.
Yeah.
Certain areas like Brisbane and Perth, I'm buying quite a lot because you get a really good bang for buck.
Yeah.
So like you can get a 6% net yield, a long lease, vacancy rates are reasonably tight, which on a 70% loan is still cash flow positive. Like on a Moon ISA, you're talking 10, 12 grand a year positive.
Yeah.
So that's easy to hold. Whereas if you go buy in like inner ring Sydney and you're getting a 4.2, that's still negative.
Mm-hmm.
So, but then also the bang for buck side is I bought an entire shopping centre in Brisbane for 3.1 mil. 3.1 mil gets me a single tenanted body corporate warehouse on the Northern Beaches at 5% versus 6%. So it's always the case. We pretty much buy every capital city at the moment besides Darwin. But again, it's case by case. There's always horrible pockets with high vacancy rates, and then there's good ones. But it's just, like I said, matching up the clients, like budget, risk profile, what they're after, and coming up from that with a plan from there.
Yeah. No, I thought that would be the answer, but it's always it's a question that I get asked regularly. Where should I be buying?
If they want a good spot, Newcastle actually is a good spot for the next 5-10 years. Like there's tight vacancy rates, good growth fundamentals. Like they'll be okay there.
Yeah.
One of the little tricks you can look at is look at the percentage of owner occupiers buying, and that's some of the areas we buy in. I used to be able to buy, and it was like 70%. Like they used to fetch a premium if it had a tenant. Now we've got clients that we bought for 4 years ago in those areas. Their tenants leaving, we're not renewing the lease, and they're selling it to owner occupiers at a 30% premium because all the tradies and that just want to get in. It's got nothing to do with the price. They want to like buy under their self-managed super fund and buy a warehouse to operate out of.
Yeah.
So they're all selling up, and then we're putting it back into a better quality asset elsewhere.
Yeah. I mean, that's the owner occupiers is the same for resi anyway, so that principle should be applied across the board.
It's a good indicator that you're in a safe market as well, because for owner occupiers to be buying, it means they're running successful businesses.
Yeah.
Which is a good kind of a diverse economy for the area. The funny one I always get is people go, "Oh, don't buy commercial. Like when there's a recession, people aren't going to be able to pay rent." And I'm just like, if the businesses can't pay rent, how are you going to pay your mortgage? Because the commercial is what services. If you live in an area, unless you work from home post-COVID, you are part of the commercial landscape. Yeah. So if they're not making money, guess what? You're not earning money either.
Yeah. For sure. Brad, it's probably worth touching on some lending now.
The fun stuff.
Yeah. Look, so sort of already briefly touched on it. So most of them are going to most of the Lease-Stock sort of stuff, you're gonna need a 30% deposit. It's as simple as that. Some even want 40%. If you are going through an owner occ, it is a full doc process. So if you are buying it to live in it or to occupy it under your business, it is a full doc. So it's usually 2 years financials, tax returns. They want to be able to see that you can service that based out of your net profit. If you had existing leases under, like, so if you're going from a lease property into that, they can take that into account. So add back the lease from the previous financial years. But generally speaking, it's much easier to buy it as an investment than it is to buy it as an owner occupier.
Yeah, one of the points I think noticing, Brad, is like if you're buying like a lease-stock property, you don't get a pre-approval because it depends what you're buying. So what actually happens is the loan to value ratio changes based on the yield. So at the moment you mentioned you need minimum 30%. Most of the lenders, that's a 6% net yield minimum to get that loan to value, because obviously the rent has to service the interest rate, which is 6.3, 6.5%. So that's where they come. If you go by 4%, you're probably buying a 50% loan to value ratio.
The pre-approvals in commercial space are pretty useless a lot of the time.
Well, it's because they don't know what you're buying. They don't know if you're buying a 3% yielding office space or a 7% yielding warehouse, where you're buying.
And the value is a lot different. Like I think you mentioned it before, the way that lenders work out the value, or valuers work out the value of a property, is a lot different to a residential property. You know, it's the lease terms, everything. So that comes into that.
Yeah, they normally do 3 methods. So they'll do like replacement cost method, they'll do the cap rate method, etc. But one of the things to notice when people forget about this is when you buy commercial, you actually have to pay the lender to do a valuation. Resi, they do the quick desktop check. You'll be looking, basically they give you a panel of 3. So here's the 3 values we're happy with. You choose one. Generally the most expensive gives you the best valuation, does it the quickest. So you'll be up for normally for $1,000 to $1,500 just to do a valuation. But that's something to keep in mind as well. When you've got equity, you need to be sure that you've got equity, because if you're going to go back to the bank, you have to fork up for the money for the valuation. So you'll normally do it like at the end of the lease when they re-sign the next lease. You know, there's a bit of growth there, then refinance.
If you're pulling the equity out as well, you want to make sure that you've got that 30% deposit. You've got then a buffer for a couple of years worth of shit, you know, whether it's vacancies or whatever it's going to be. So yeah, that's something that I always recommend in these situations is don't just pull your 30% plus stamp duty. Work out how much of a buffer you're actually going to need for that property and set it up as a separate account for that property.
Yeah, so we'll generally, like, off the record recommend those, because like I said, if we're buying a warehouse and we see like, okay, they're all getting filled in less than 5 months, we'll probably say, hey, look, have 12 months worth of mortgage repayments as a minimum. And then if they are signing a new lease, you can actually use the positive cash flow to help build up another buffer. Like, don't just pull out the positive cash flow, let that build up the buffer. Then when they re-sign the new lease, you can obviously reduce the buffer if you need. The other kind of technique we do is if you're buying multiple commercials, make sure your leases are ending at different times. So have one end in 2025, one in 27, one in 28. So you can actually use the same buffer for multiple properties.
So your cash flow is not screwed all at one time. Worst case scenario.
Steve, I'm sure you've seen or been involved with a lot of transactions and dealt with different brokers and clients and different property types. I always love creative strategies. Is there ever been creative strategies with manufacturing equity or being able to use a different method for financing or something like that?
Yeah, good question. That actually changes over time. So 7 years ago when I was buying my first commercials, like I mentioned, owner occupied served a lower price than a tenanted one. So the simple strategy we'd actually do is just go buy a vacant one, put a tenant in, get your 20% uplift, easy, happy days.
Yeah.
Not so easy now when it's the other way around. Something to note as well, probably for education purposes, if you buy a vacant property, you do have to pay GST. So there's another 10%. You will get that back on your first BAS statement or however you're kind of structuring it with your tax. But all of a sudden, you don't have the rent coming in necessarily. So you've got a bigger deposit and you've got a 10%. So you can be up for like 40, 50% deposit to buy the asset. So that's obviously a lot harder to get into.
Yeah.
The other ways, probably like I said, just mentioned before, just doing simple things like putting a mezzanine area or increasing the net lettable area. A lot of the stuff we buy is just under rented. You find something that's kind of the rents are undercooked by 10, 15, 20%. And then over the next 2-3 years, as obviously it comes up for renewal, you bump it up and you get that uplift that way as well.
Yeah.
Correct. Any final things you want to discuss before we wrap things up?
I'd probably, it's going to sound airy fairy. Just be honest with yourself and work out what your actual goal is. Like that's where I see most people fall over. They set this big target, which they think, which means you got to take unnecessary risks. If you're realistic and you're like, oh, cool, like you can get a passive income very quickly in commercial. And the example I'll use is, let's say you bought $1 million asset on a 70% loan to value ratio. Even with today's interest rate environments, in about 12 years' time, that debt will be paid off. And at a 6% net yield with small rental increases, that'll be around an 85 grand passive income. Like that's a pretty powerful thing, being like, okay, in less than 15 years from buying $1 million asset, I'm going to have around an 90 grand passive income. And then that's where you can do the risk profile. If I all of a sudden go, oh, I want a 200K passive income in 5 years, like you mentioned, I got to do value adds and this and this. All that stuff comes with risks. You don't get to buy a value add that's risk-free. As we know, like I mentioned, keep mezzanine areas. You can get knocked back by building a mezzanine area. You can buy a property, and if you don't know how to talk to council and town planners, because you need extra car spots, if you buy a warehouse and you increase the net lettable area by 30%, you need 30% more car park sparks. So if you're a body corporate, you can't do that. That's going to get rejected. So you might have bought it with a premium, etc. So work out your goals. Make sure you do your due diligence. My two biggest things.
Yeah. Awesome. The thing is that those risks come with resi as well. If you're going for a value add, obviously your property's got to be vacant to do the value add. So, you've got to have that, cash to contribute to that mortgage for, your vacancy period or whatever you're doing. So again, that just comes back to your risk profile with resi as well.
Yeah, exactly right. So you've still got the same risk there, and then probably more with commercial as well because of the vacancy periods and the types of tenants, and it's just a not understood space.
Yeah, for sure. Anything else, Brad?
Perfect. No, that's it for today. Thanks for joining us, Steve. It's been great having you on there and talking a bit commercial, and we'll catch up soon.
Awesome. Thank you so much, guys.
Thanks, Steve.
No worries. Thanks, mate.